In this video we will learn about IAS 12. Income taxes. IAS 12 is part of the IFRS standards issued by the IASB. No superseding standard has been issued to replace it. Though in 2021 the IASB issued minor clarifications on deferred tax related to assets and liabilities arising from a single transaction, for example, leases. The core principles remain unchanged. IAS 12 Income taxes. Prescribe the accounting treatment for income taxes, ensuring consistent recognition of tax effects in financial statements. Key components of IAS 12 are current tax and deferred tax. IAS 12 ensures that entities recognize 1. Current tax, the amount payable to tax authorities for the current period. Current tax is recognized as a liability if unpaid, or as an asset if overpaid. It is measured using tax rates enacted, or substantively enacted, at the reporting date. 2. Deferred tax is future tax consequences of temporary differences between accounting and tax values. Deferred tax arises from temporary differences between the carrying amount of assets or liabilities and their tax base. Taxable temporary differences result in deferred tax liabilities, for example, depreciation differences. Deductible temporary differences result in deferred tax assets, for example, provisions not yet tax deductible. Exceptions. Deferred tax is not recognized for 1. Goodwill, unless deductible for tax purposes. 2. Initial recognition of assets or liabilities in certain transactions, for example, leases under IAS 17. 3. Recognition and measurement. Deferred tax is measured using the tax rates expected to apply when the asset is realized or liability settled. Discounting is not permitted. Deferred tax assets are recognized only if it is probable that future taxable profit will be available. Number 4 is presentation and disclosure. Current and deferred tax are recognized in profit or loss unless related to items recognized outside profit or loss. For example, other comprehensive income or equity. Disclosures include 1. Tax expense reconciliation. 2. Details of deferred tax assets or liabilities. 3. Unrecognized deferred tax assets, for example, due to insufficient future profits. Why IAS 12 matters? IAS 12 avoids mismatches between accounting and taxable income. It ensures transparency, for example, DTAS signal future tax savings. It is helpful in global comparability for investors. Key takeaways of today's topic. 1. Current tax is today's obligation. Number 2. Deferred tax is future consequences of temporary differences. That sums up our today's topic. If you have any question, ask in the comments section.